If your company buys imported goods through a trading company, a middleman, or a foreign vendor rather than buying directly from the factory, you are voluntarily paying the government extra taxes on another company's profit margin. Welcome back. Today we are looking at one of the most lucrative, legally approved cost-saving strategies in global trade. It is called the first sale for export rule, and it literally saves multinational brands millions of dollars in import duties every single year. To understand how powerful this is, you need to look at a standard multi-tiered supply chain. Imagine you are an importer. You place an order with a trading company in Hong Kong for a container of jackets. You agree to pay the trading company $10 per jacket. The trading company then goes to a manufacturing factory in Vietnam and buys those exact jackets for $7 each. The factory ships the goods, they arrive at your border, and your broker declares the value at $10. You pay your import duty on that $10 price. But think about what just happened. $3 of that invoice is simply the trading company's profit margin. Under standard logic, you are paying a customs tax on a markup. The first sale for export rule allows you to bypass this. If you meet strict legal requirements, customs authorities will actually allow you to declare the $7 factory price at the border, completely legally, even though you paid the trading company $10. You instantly reduce your tax liability by 30%. However, because this strategy takes massive amounts of revenue away from the government, customs heavily audits it. You cannot just guess the factory price and put it on your declaration. You have to prove it with absolute certainty. To successfully execute a first sale strategy, your transaction must meet 3 non-negotiable legal tests. First, there must be 2 distinct simultaneous sales. A sale from the factory to the middleman and a sale from the middleman to you. Second, the goods must be clearly destined for your specific country at the exact moment the factory sold them to the middleman. They cannot go into a general warehouse inventory overseas to be sold later. You prove this by showing that the factory printed your country's specific safety labels, language tags, or your corporate logo on the products during manufacturing. Third, and this is the hardest part, you must provide a complete, unbroken paper trail. You need the original factory invoice, the factory's purchase order, and the actual bank transfer showing the middleman paying the factory the $7. This creates a massive commercial conflict. Your middleman does not want to give you the factory invoice, because then you will see exactly how much profit they are making off of you, and you might try to cut them out of the deal completely. So, how do major brands solve this problem? They use a blind trust or a third-party trade compliance auditor. The middleman hands the highly confidential factory pricing data directly to the independent auditor. You never see the factory's invoice, protecting the vendor's commercial secrets. The auditor packages all the documentation into a secure legal file and submits it directly to customs. Customs gets the proof they need, the vendor keeps their margin secret, and your company saves millions in import duties. If you have a multi-tier supply chain and you are paying high duty rates, the first sale rule is the most valuable tool in your compliance arsenal. Are you currently buying through a middleman and paying duty on their markup? Drop a comment below and let's discuss how to set up a blind trust to start claiming your first sale discounts. Thanks for watching. Protect your margins, optimize your valuation, and see you in the next video.